Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report that's all about money, but not the kind you'll find in your wallet. Get ready, because we're about to unlock the vaults of Dreyfus institutional liquidity funds, and trust me, there's more to it than meets the eye, or should I say, less. So what exactly is this document all about? Think of it as a very fancy official update for the people who've invested their money in the Dreyfus Treasury and Agency Liquidity Money Market Fund. It's basically a look under the hood of how this fund is doing, especially focusing on its financial health and what it's invested in. This fund, it's a money market fund, which means its main goal is to keep your money safe while giving you a little bit of income. It's like putting your money in a super secure piggy bank that pays you for keeping it there. Let's look at some of the key numbers. As of May 31st, 2025, the fund was managing a massive amount of money with a total fund size of 11,008 holds just 10 things in its portfolio. 10, that's a lot of eggs in very few baskets. Now let's get into what's actually inside this fund. If you look at the statement of investments, you'll see that almost all of it, a staggering 100.2%, is tied up in something called repurchase agreements. What's a repurchase agreement, or repo for short? Imagine you have some valuable stuff like government bonds and you need cash. You can sell those bonds to someone and agree to buy them back later at a slightly higher price. The buyer is essentially lending you money and the bonds are used as collateral. It's a common way for financial institutions to borrow money for a short period. We see a lot of these repurchase agreements with big names like Banco Santander, Bank of Montreal, Citigroup, and HSBC. The fund is basically lending money to these banks and in return it's holding US Treasury bonds as collateral. The total value of these repurchase agreements is enormous, over $11.8 billion, and the fund is getting a yield, which is like the interest it earns, ranging from about 4.25% to 4.34%. After accounting for some liabilities, the total net assets of the fund are a little over $11.8 billion. Looking at the statement of assets and liabilities, we see the fund's investments are valued at $11.86 billion. It also has some interest receivable and prepaid expenses. On the liability side, there are amounts due to its investment advisor and affiliates, some cash overdrafts, and other accrued expenses. Crucially, for a money market fund, the net asset value per share is $1.00. This is what they aim to maintain. Now let's peek at the statement of operations for the 6 months ending May 31st, 2025. The fund earned a significant amount in interest income, over $23 million. However, it also had expenses including management fees, registration fees, and fees for trustees and custodians totaling around $4.3 million. This left them with a net investment income of almost $99.4 million, which is the profit generated from their investments. Looking at the statement of changes in net assets, we can see how the fund's value has changed over time. For the 6 months ending May 31, 2025, the fund actually saw its net assets increase by over $2.5 billion. This increase was largely due to new money coming in from investors buying shares, bringing in over $83 billion, while redemptions, meaning money going out as people sold shares, were around $81 billion. The financial highlights table is where we can see the year-over-year performance. For the 6 months ending May 31, 2025, a single share of the fund returned about 2.17%, and this is not even annualized yet. The expense ratio, which is a measure of how much it costs to run the fund, is a very low 0.09%. This is quite good for a money market fund, especially when you consider the management fees. And the net investment income ratio is around 4.31%, which reflects the interest it's earning on its investments. The notes to financial statements provide crucial context. For instance, they explain that the fund values its securities at amortized cost, a common practice for money market funds to maintain that stable 1.0 NAV. Regarding how they value things, most of their investments, all $11.86 billion worth of repurchase agreements, fall under level 2 of the fair value hierarchy. This means their value is based on observable inputs like interest rates and prices for similar securities, rather than unquoted prices or the fund's own assumptions. The fund's policy on repurchase agreements is quite detailed. They require collateral to be at least equal to the repurchase price plus interest, and if the collateral value drops, they can demand more. This is a pretty standard risk mitigation strategy. Under market risk, they also highlight counterparty risk with repurchase agreements. This means there's a chance the other party in the agreement might not fulfill their end of the deal, which is a risk to consider when you're dealing with financial institutions. Finally, there's a statement about how the fund's board of trustees approved the contracts for the investment advisor and sub-advisor. They reviewed services, performance and fees, comparing them to similar funds. They found that the fund's performance was good, fees were reasonable, and overall, they decided to renew the agreements. This shows a commitment to their management team and strategy. Now let's talk about what this all means. The Dreyfus Treasury and Agency, Liquidity Money Market Fund, is essentially a very large, very safe place for big institutions to park their cash. Its strategy is super simple. Lend money using US Treasuries as collateral. The low expense ratio is a huge plus, meaning more of your money is working for you. The focus on repurchase agreements with major banks shows a conservative approach to preserving capital, which is exactly what you want in a money market fund. The good side is that the fund is stable and profitable, attracting significant new investment. The bad side, if you can call it that, is that it's so focused on just a few types of assets with very similar risks. The main risk here for investors is credit risk. What happens if one of these major banks faces serious trouble? While the collateral is supposed to protect against this, it's still a concentration to be aware of. The board's approval of the advisory contracts suggests they are comfortable with the current management and their approach. It's a solid, if not terribly exciting, report. It tells us the fund is doing what it's supposed to. Solid, if not terribly exciting, report. It tells us the fund is doing what it's supposed to do, keeping money safe and earning a modest return with very low costs. Alright, that's our breakdown of this Dreyfus Funds filing. What's your take on this ultra-conservative investment strategy? Do you think concentrating so much in repurchase agreements is a smart move? Drop your thoughts in the comments. If this deep dive into financial documents was helpful, please hit that like button and subscribe for more. And for even more exclusive content and discussions, join our Discord community. The link is in the description below. Thanks for watching and see you next time on Corporate Decoder.